Hello and welcome everyone. I know a lot of investors are worried about the steep correction in equity indices. The Quantum Long Term Equity Value Fund traditionally has managed downside risk remarkably well, and even in this correction has fallen a lot less compared to the benchmark. In this video, let's understand from the fund managers, George Thomas and Christy Mathai, what their secret sauce is in managing downside risk. George, to start with a broad question, value funds generally do a lot better during a market correction. Can you tell us why that is?
Sure, yeah. So I would explain with an example. So if you look at the screen shown here, there are two funds. There is a fund one and fund two. Fund one in year one, it rises by almost 90%, whereas fund two rises a lot lower by just about 46%. So in this example, fund two is more sensitive to valuations and therefore it may not participate in the final stage of the bull market. When some of its holdings turn expensive, it would be selling out of those names. And since markets on an overall level is expensive, it may not be finding opportunities to redeploy those exited cash. And therefore, it might be having a higher cash holding. And when a volatile year like year two comes, fund one falls by about 75%, whereas fund two falls a lot lower because it has been holding less expensive shares where the downside risk is lower, and it has certain amount of cash which it got by selling some of the overvalued names. And if we were to compare the cumulative performance of fund one and fund two, fund one need to rally by almost 63% just to reach the level at which fund two entered the second year. So this is how a typical value fund would perform. Since it is more sensitive to valuations, it might trail the benchmarks and some of the peer funds in a bull market phase. But because of its superior downside protection, on a cumulative level over the cycle, it would outperform the markets on a broader basis.
Thanks for that, George. Christy, coming to you, can you tell us what the process for the Quantum Long Term Equity Value Fund is and why does it outperform during market corrections?
Sure. Uh, what we're trying to do in our quantum long-term equity portfolio is we are essentially trying to buy a stock at a discount to its intrinsic value. And for example, let's say the intrinsic value of the stock is 100 rupees. It is our endeavor to buy that or get into that stock which we deem fundamentally strong and so on and so forth at least 25% discount. So our entry price would be around 75 rupees. And if our research is right, so over a 2-year horizon, that 75 would move to 100, which is roughly 33.3% returns over 2 years, which is roughly 15.5% CAGR returns over the 2 years, 2 times what we see in 10-year government bond. So at different points in the cycle, for example, in the euphoric stage of the market, essentially sell limits are getting hit for most of the stocks. So and if we don't find enough reasons, we are selling out of those stocks, and the cash would build up in that state. At a similar point, at the same time, if there is a deep correction, we would enter into many of these stocks because now the valuation has become conducive and many stocks are hitting our buy limits. So just to illustrate this point, here is a fascinating chart that we have been tracking for since inception. So the at every point in time, a stock in our portfolio has a clearly defined buy and sell limit. And if you were to multiply the sell price with the current traded price, you arrive at a upside potential for that stock. And if you were to take a weighted average of each of these stocks into weights, we would arrive at an upside potential for the portfolio. And we have tracked down this upside potential for the portfolio since inception. And the orange line that you see here is the tracked upside potential for the stock. And what you see, the blue line is the actual realized NAV for that portfolio. So what you see is a very tight fit between, the predicted and the actual, barring certain global disallocations like GFC crisis or COVID-19. So this tells you that the process that we follow is extremely disciplined and consistent across market cycles.
Thank you for that explanation, Christy. George, coming back to you, unlike most mutual funds, cash levels for quantum long-term equity value fund has been high and even historically has been as high as 30%. Could you tell us what the reason is for that?
Sure. So when we look at quantum long-term equity value fund, it follows a very disciplined process where we exit or start trimming a position once a stock reaches its sell limit. Sell limit is where we feel the fair value of the stock should be, or if market values it correctly, that should be where the stock should trade. And as the stock moves or crosses the sell limit, we would start trimming the stock. So therefore, in a bull market, when market euphoria sets in, it is very much possible that many of our stocks would be hitting those sell limit and we would start trimming. And in such a scenario, if we are not able to find an alternate opportunity which meets that threshold upside levels, we would be raised the cash levels, you would see the cash levels moving up. And that is precisely what has happened in the recent times. While it could be a drag in terms of in the last phase of bull market, but it helps us to redeploy that cash at names where the upside levels are reasonably good in a period of market volatility. And that we have seen that even in the recent times. So in certain volatile days, we would see that us falling a lot lower than the market. And that is one advantage. And the second thing is we were able to redeploy this cash into some of the existing names and a new name where the upside potential turned attractive over the course of the last year. And therefore that we have seen this happening over multiple cycles in the past, where cash levels build up during the late phase of bull market, and as and when the market turns attractive, we are able to redeploy that to more names or existing names when the upside levels turn attractive.
Right. So thanks for that, George. And I think talking about that, Christy, how is the fund positioned today? And, just adding on to that, what advice would you have for the investors?
Right. So if you were to look at the portfolio positioning, we have very large weights in financials, roughly around 41%, and bulk of it is into private sector banks. In the last 2 years, we've been able to find more opportunities within the insurance space, in AMC, and so on and so forth. But large bet still remains within the financials bucket. And where we think, especially if you were to look at the private sector banks, the valuations are very attractive, perhaps at decadal lows, if you were to look at it, for a pretty reasonable growth that one can expect. And the second largest position roughly is on the cash, where as George mentioned, that this cash can be deployed pretty aggressively if the markets were to correct meaningfully. So in the past also, as the market corrects, we have been able to deploy the cash. So now we also have few ideas which could potentially come into the portfolio, but again, we are waiting for a good entry point into most of these stocks. Coming to the second question about how should investor really think about investment at this point in time. So if you are an existing investor, who have built your position over a period of time, our advice would be to remain invested, provided you have a long time horizon. You should not be worried about volatility. In fact, you should use that to your advantage. But if you're looking to deploy, a lump sum investment, our advice to you is, if you have 100 rupees to deploy, probably deploy 50 rupees or 70 rupees, somewhere in between. And you can progressively deploy as the market levels, market corrects, or, the entry point is better. So that would be the advice to the investors, Riya.
Thank you, George. Thank you, Christy, for all your insights on how you managed downside risk in the quantum long-term equity value fund. I hope our investors are able to apply these insights in their equity portfolio.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.